We are finally ready for our panel, so I'm going to invite Jack up to the stage again. And he's going to share an overview as to what this panel is, because it's specifically around the industry. And Jack, please join us.
Thank you, Crystal. I hope everyone's enjoying their lunch. Help yourself. We're going to have a panel. There's going to be 3 individuals in the panel, and we have a panel moderator. So just a little bit about the context here. A lot of what we do is not just raise capital for companies, take companies public, but also help companies mitigate risk, whether or not they should list on a Canadian stock exchange, a US stock exchange, whether they need to cross-list, dual-list, up-list, and even look at other exchanges outside of Canada and the US. So these are things that we look at. So risk management is something that's very, very near and dear to ArcStone. We don't want to put clients unnecessarily at risk. We don't want to put clients in positions where they're not going to have liquidity in the markets, or they're going to have lack of liquidity, or they're not going to get the optimal market valuation, et cetera. So we pay a lot of attention to dealing with the right counsel in the US, whether it's a mergers and acquisitions mandate. Does this acquisition make sense? Does this mandate make sense from a market perspective, credit perspective, business perspective, regulatory perspective, and otherwise? So this panel is going to focus on various issues around risk management with respect to how market makers deal with it, things that insurance companies can help you with in terms of public companies and private companies, and as well as we have an accounting firm deal with some of the accounting issues, whether they be financial accounting or tax accounting or tax implications. So with us today, leading the panel, is just a bit of some other context. We deal with a lot of lawyers on the street, both in Bay Street and on Wall Street. And it's rare that you come across a lawyer who is expedient, returns the emails, is dynamic. We hired this particular law firm for our M&A mandate. It was a fairness opinion that we provided for a company called CheckCap, which was a NASDAQ listed company. It was a Canadian company that was acquired by Noble AI, which is here today, Regan. And normally a fairness opinion is done over a 4 to 6 week period. Well, we were tasked to do it in 2 weeks. We got this done in 2 weeks, which was miraculous. So all of our staff, thanks to the ArcStone staff, the juniors, the analysts, the partners, we're running around the clock on this file to get this done in 2 weeks, including the law firm that got it done in 2 weeks. So without further ado, I want to introduce Joe Lucosky of Lucosky Brookman, who will be moderating the panel. Joe, please take it away.
All right, good afternoon, everybody. I just want to say before we get started, thank everybody from ArcStone and Kingswood for putting on this fabulous event. We attend a lot of events throughout the year, and I just want to say that this is very nicely set up and very well attended. We're very impressed with the architecture and how this is playing out this afternoon. So thank you to everybody from ArcStone and Kingswood. Today, we're going to speak about, thank you. Yeah, please, clap. They deserve it. They deserve it. Especially all of us who traveled from out of town. Thank you again. So today we're going to speak about the state of the microcap markets and specifically how they are doing in the IPO, uplist, and cross-list worlds. And before we get started, I just want to mention that we're going to talk about a lot of data today because we believe, at least at Lucosky Brookman, that data is extremely important, not just on the financial side, but also on the legal side, the business side, and the execution side. We can make better decisions through data. And at Lucosky Brookman, we actually have a dedicated data desk that tracks every single microcap transaction in the US that goes on the senior exchanges, namely the NASDAQ and the New York Stock Exchange. Every deal that comes out sub $300 million in the IPO, uplist, and cross-list world, our data desk tracks, analyzes, pulls apart, puts back together, and then curates information, puts out to the marketplace so everybody can see what is going on in the microcap world. And that's special because the exchanges don't necessarily track microcap. They track larger deals. So we've took it upon ourselves to put this information out. So we're going to talk about a lot of data today. For those of you who don't know me, my name is Joseph Lucosky, and I am the managing partner of Lucosky Brookman. We are a 60-person boutique securities and entrepreneurial law firm located in the New York, New Jersey area. We practice federally across the country and internationally here in Canada and other places abroad. Before we dive into some of the data and details that we're all here to talk about, I'd like the panel to introduce themselves. Today with me is Peter Simeon, Mert Guler, and Jeff Gamble. Maybe guys, you can introduce yourselves quickly.
Yeah, not a problem. Hello everyone, my name is Peter Simeon. I'm a partner at Gowling WLG. Gowling is a large international law firm. We have offices all through Canada, Europe, and Asia. I practice in the areas of corporate finance and M&A. I take companies public, do public and private M&A and financing work. I've done a lot of mining work, a lot of cannabis work, a lot of tech work over the last sort of 20 years of my career. Looking forward to being on this panel.
Thanks very much, Peter. My name is Mert Guler. I'm with Purves Redmond Insurance. We're a leading Canadian boutique that helps private and public companies manage their risks, all the major industries in Canada. And kind of, I think our special niche is helping growth stage companies or companies when they're about to go public. And we can grow with you with sophisticated risk advisors. Whatever your industry is, we can help grow with you as you expand.
I'm Jeff Gamble, Managing Director of ITG. We're a issuer designated market making firm, helping illiquid small cap and mid cap companies with their volume on the exchange, on the exchange in Canada and in the US.
Right, thank you guys. So let's jump right in here. And today we're going to talk about a number of topics, but I want to highlight just a couple. We're of course going to talk about the state of the microcap IPO, uplist, and cross-list market. And there's vast differences in those markets, at least as companies are coming over to the US and listing on the NASDAQ and the New York Stock Exchange. If we have time, we'll get into the sort of Cboe disaster that occurred in the US on the senior exchange and compare that to the New York Stock Exchange and NASDAQ if we have time. We're also going to talk about the trend that we are seeing in the marketplace, and this is probably very interesting to everyone in this room, the increased participation of foreign private issuers in the marketplace, specifically in the US, again, on the senior exchanges. We're going to talk about the selling shareholder phenomenon, which is a double-edged sword on how to qualify in the US and how to get those deals completed. And then we're just going to talk about some general industry news wrapped around the uplist, cross-list, and IPO market. So let's jump right in. I want to walk through this slide and set the stage for the panel. This slide that everyone is seeing right now is literally the entire US marketplace on one piece of paper. It is an incredibly popular slide. I will just say, everyone, you can take pictures of it. This slide is posted all around the internet. It's copied by banking firms, law firms, competitors. Everybody loves this slide because it really wraps up the entire marketplace in a nutshell. Let's just go through some of the data. And as I'm talking here, I want everyone to keep in mind, we're tracking right now our data desk from 2021 through August 31st, basically September of 2024, the US capital markets on the senior exchange side. Again, this is for IPOs. And I want everyone to understand that the data you're seeing in all of the blue boxes for 2021 was really coming off the COVID year, or was the COVID year. You can see that was the boom year for the markets. 2022 was a remnant of 2021, the COVID year, and really represents lots of activity through October of 22. Then the NASDAQ pause hit, which really slowed deals down for the remaining of the year, that fourth quarter. 2023 was a year of recalibration. We say less was more in 2023. And then in 2024 is really tracking on the heels of 2023, where raising less money seems to be the popular trend, which calls into question the selling shareholder discussion we're going to have a little bit later. But if we look at these 6 categories, you'll see number of deals have come way down from the 2021, but they're still getting done. Deals in the marketplace are happening. You know, last year was a surprise to everybody. 87 microcap IPOs printed. If you talk to anybody in the industry, they think that's a shocking number. In fact, I had conversations with some of you here today, and they couldn't believe that 87 deals printed last year in the microcap IPO world. And I think the reason for that is number of deals have been strong, but dollars raised has been less. So what we're feeling in the marketplace is the less dollar raised, the harder deals are to get done. But the deals are there. The number of deals are happening. If you look at the next category, you'll see the increased participation by foreign private issuers, and we're going to talk about that on the next slide. Let's talk for 1 second before we open up to the panel on dollars raised and median offering size. You can see dollars raised has come way down. That's just a function of the median offering sizes being way down from 2021, 2022. It used to be that the average deal price or median offering price was upwards of $20 million in 2021. And it's historically trending down in 22, 23, and now 2024. We're down to about $7 million as a median raise for a microcap IPO, which again calls into question the selling shareholder or legacy shareholder phenomenon, which we're going to talk about. And that's on the last slide. So let's talk to the panel for a second. Just given the state of the market and all the conversations we've had in preparation for this, give us your thoughts on what you are seeing in your respective areas, both from a Canadian legal perspective, a risk mitigation perspective, and of course a market making perspective, just on this data and the cross-border nature of the market. And maybe Peter, we'll start with you.
Yeah, sure. So the slide doesn't shock me. It's actually a great indication of what's going on. The capital markets in Canada have been dead for at least a year, if not longer. It's almost impossible to raise money in Canada in the microcap space. And so what our clients have done is they've decided to go to the US and raise capital there, where you can still raise capital. And if you're raising capital in the US, you're going to list in the US. So we're seeing a lot more US NASDAQ listings. We're seeing a lot more deals with US investment banks, and a lot less, with Canadian dealers or listing in Canada. So this slide is actually bang on in my view.
Wonderful. Mark?
Thanks. I'm from the insurance world, so I'm going to talk just a little bit about some of the risks when you're going public or uplisting. I see it a little bit of good news and bad news. I'll give you the bad news first. Is when you're uplisting into the States, as probably everybody knows, the risks are much higher. It's like when you're going from private to public in Canada. It's like a logarithmic increase in risk, and then when you're going into the States. So I've got some data for you. Okay, so you guys, I don't want to be outdone with data, though. I don't have a chart, but the number of lawsuits in the United States, litigation, securities class action litigation against public companies, it's 4 times more as a likelihood. The probability of getting sued in the States is 4 times more. The severity, the median settlement is 7 times what it is in Canada, and just so the risks are at a different level. So unfortunately, higher risks. Unfortunately, insurance costs more. You need more of it. But the good news is, I want to end on a little bit of a positive note, is the market for insurance is really tapering off in a good way. It's a bit more of a buyer's market. At the beginning of COVID, you may have, if you're involved in any kind of directors and officers deals, the pricing just went through the roof in the beginning of COVID 2020, 2021. It's really come down significantly. We just did a deal with Peter's firm with a client who went public on the New York American Exchange, and we gave them some pricing parameters. The pricing end up for their D&O program was half of what we thought. So the market's coming down fast, quickly. So that's some positive news as a silver lining.
I think what Mert was trying to say, that there's too many lawyers in the U.S., number one.
Not enough.
Not enough, okay, given the amount and percentage of settlements. But I will say, just on the insurance piece, and I know that goes under the risk mitigation category, but when we see these deals on the IPO side and the cross-list side specifically, D&O has been a very challenged market and over the last year or two. And it's important because not just is the market data challenged, but without D&O, deals generally don't get done because boards of directors refuse to move forward. Bankers refuse to move forward. We have seen bankers refuse to move forward on a deal unless the board has an adequate D&O policy in place. So we feel that very much from the trenches. I don't know if you have a further comment on that, but that's sort of what we see on the legal end, at least in the U.S.
Absolutely agreed. And we work with a lot of law firms, and sometimes these lawyers like Peter here are asked to sit on the boards. Well, they can't sit on a board unless the board has minimum insurance threshold that even the law firm requires. And an independent, of course, doesn't want to have that kind of risk. An independent director wouldn't want that kind of risk. So, like my wife says, I'm a necessary evil.
There isn't one IPO or going public transaction I've been involved in that you don't see a lawsuit on the eve of going public. It's very typical. In Canada, you see that all the time. The US is just amplified. You'll always see it. Every M&A deal in the US, you'll see a lawsuit. It's very typical. So if you're planning on going public in the US, you definitely need to be prepared for that. Get the right insurance. Make sure you have a good litigation strategy, a good communication strategy, because you're going to have to deal with it.
Yeah. I agree to an extent. I mean, thank goodness there's some wood here to knock. Our deals have not been sued on the eve of IPO, but it is something you should plan for and be prepared for. I think it really depends. The reason why I think litigation has become a little bit more in the news on the eve of IPOs and especially de-SPACs is because the market has been more volatile over the last year or two. And when you have deals coming out that are going out at 5 or 6 or 7 or 8 and then trading down at 2 or 3 or 4, just for whatever reason, economic reasons, political reasons, geopolitical reasons, doesn't matter. The plaintiff's attorneys, at least in the U.S., sniff around. And this goes back to why we have too many lawyers in the U.S. But the point is the markets are open, the deals are getting done. And before we go on to the next slide, maybe, Jeff, you can give us your perspective on just the trading piece, especially here in Canada, because I know a lot of people here are Canadian.
Very challenging trading environment. Volumes are really low. Confidence is low. And without help, an active market maker, somebody managing on a daily basis, it's some of these companies who are constantly trying to raise money aren't supported. They're not bid.
Yeah. Well, we're going to talk a lot more in a future slide about uplist and crosslist, but just to get what Peter has said earlier, that the Canadian markets have been somewhat dead. Has that been your experience, dead as far as liquidity and difficulty in raising money, and that's why many companies are flocking to the U.S. in whatever form, whether that's OTC or a senior exchange, NASDAQ, New York Stock Exchange?
We see that, yes.
Yeah. Okay. Well, let's go on to the next slide, because I think as we keep this general slide, and we'll keep referring to this throughout the presentation, we are seeing a very, very substantial trend in the U.S., and that is the increased participation by foreign private issuers. Now, I will tell you, there's a huge distinction on the IPO side from the uplist, crosslist side. And just for those of you that aren't familiar with the terminology, obviously an IPO is a private company that is now taking its first steps to go public and have public shareholders. Uplist and crosslist are terms that we refer to as either a U.S. company that's on a lower trading platform, uplisting to the NASDAQ or New York Stock Exchange or a senior exchange, and a crosslist is what you would do from Canada or Israel or Asia. If you're traded overseas, coming to the U.S., sometimes you'll have a dual listing with the OTC, but we'll generally talk about that as a cross-listing opportunity to NASDAQ and New York Stock Exchange. And what we're seeing, if you look at this slide, you'll see that the increased participation is really at a breakneck speed by foreign private issuers as far as number of deals. The domestic are highlighted in blue, and the foreign private issuers are highlighted in yellow. And you can see, not since 2021, which was the COVID year, which was completely dominated by domestic U.S. issuers. Now, 3 years later, as the market has worked itself out over the NASDAQ pause of 22, the less is more year of 23, and now 24, foreign private issuers have really overtaken the U.S. capital markets. And I don't have this data on here, I have it on my slide, but the number one jurisdiction the number one jurisdiction, this is very surprising to a lot of people, of foreign private issuers, again, companies where they are domiciled, is the Cayman Islands. Everyone must smile at that and say, what's in the Cayman Islands? Well, it's not really the Cayman Islands. You have to dig deeper in the data. Cayman Islands is the jurisdiction of domicile. It's really companies operating over in Asia or other parts of Europe that re-domicile for either tax reasons or other synergies in the Cayman Islands, and that becomes the data that we track. But they're generally Asian or other abroad US-based companies. Now, different than the uplist market, which we're going to talk about, where there's more Canadian companies and Canada dominates that market. This is just the IPO market. So I don't know if, I'm sure, Peter, you may have some thoughts on this, but why are we seeing foreign private issuers dominate the US market as far as IPOs? You know, some people have said it's more mature companies, larger companies, bigger revenue. The market is not willing to put up with spec plays or pre-revenue companies these days. I mean, what are you seeing and why do you think? Because you are the foreign private issuer market. That is your market.
Yeah. Well, again, as I said earlier, in Canada, it's a challenge to raise capital. And you know, if you're a certain size here, you become a very big company. A similar sized company in the US is actually a smaller company, and it's a little bit easier sometimes to raise capital. So we're seeing our clients go raise the capital in the US, list in the US, they end up having US shareholders. They need to actually have a US listing. I'm not surprised on the Caymans. We see a lot of people going into tax, free or neutral jurisdictions as a way to list. We also see a lot of, Asian companies, whether it's Chinese or Hong Kong, using that avenue to list. It's a bit more challenging from some of those markets to list directly these days, and so they're choosing to go through other jurisdictions as a way of just make it easier, frankly, to get through some of the stock exchange requirements. I know in Canada, if it's an emerging market, you have a different lens that the stock exchange will use versus a more established place like the Caymans. You'll get less scrutiny. So I think that's one of the reasons.
How come we don't see the Bahamas? Don't Canadians love Bahamas?
They do love the Bahamas. They do.
We'll have to fix that. Well, let me just ask you a question to you, Mert, before, because I want to give a little bit more data on this foreign private issuer, because I think you'll find it very interesting, and you have to dig a little deeper. Is there a difference if you're an Asian-based company, a Canadian-based company versus a US-based company in getting D&O and mitigating that risk in far as premiums, timing, execution? Just talk about that for a second, because this issue comes up all the time on our deals right now.
It's a really good question. The real risks and what the insurance company is going to be looking at is your jurisdiction of incorporation. So if you're based in Canada or China or wherever you may be, that's the center of where the directors and officers insurance and all your insurance policies need to be based. However, the riskiness and the pricing and the coverage and terms and how risky that is going to be based on if you're just listed publicly in Canada or private in Canada, or if you're cross-listing or uplisting into the States. So I mean that answers part of your question.
Do insurance companies look through, though? So say you are Asian-based or Canadian-based and you re-domicile in the Caymans for tax reasons, let's say, but you've been there for all of 5 minutes. Do they look through?
Yeah, they'll know that. And that's a negative. That'll be a little bit of a negative on your portfolio of risk, but that's not to say that you may not be able to get insurance. But they want, of course, I think we all know insurance companies are conservative. They want stability. They want stability. If you're based in China or Europe or Israel, we see tons of Israeli deals. They would like long track record of operation or domicile in that country. One good thing just to mention is that while the insurance policies are based in your country of domicile and where your business is registered, the policies worldwide. All of these policies, directors and officers and other liability policies, are typically worldwide policies. So if you're sued in the United States or wherever you may be sued, coverage will be available for you. Double check with your insurance provider, double check with your lawyer, just to make sure. But typically that's the case. So that makes it a lot easier. You as an executive don't have to worry about where you're getting sued. You're going to be covered, assuming the lawsuit is within the scope of coverage. But the policy should be purchased where your business is domiciled. Although the riskiness and the premiums and the terms will be based on wherever you operate and wherever you're publicly listed.
Let's just talk about jurisdiction for 1 second. I wish it was on this slide, but it's not. So the jurisdictions that make up the most foreign private issuers coming to the IPO market in the United States, I'll just read these off and then I'll explain. Cayman Islands by far. 70% of the deals are coming out of the Caymans and the British Virgin Islands. And again, that's for tax and other reasons. The data behind that, though, most of those companies are from Greater Asia. So coming out of China, Hong Kong, Singapore, Indonesia, even some Japan. And then there's a smaller subset coming out of Israel, Canada, and Australia. And that makes up the foreign private issuer IPO market in the US. But it is a trend. Domestic companies in the US have been way down. And I think, at least in what we're seeing, the foreign companies are slightly more mature, and the market is looking for a little bit more mature these days, stronger balance sheets, top line revenue, as opposed to lots of excitement in the future or betting on some sort of future type of revenue or other metrics. So let's turn for 1 second now to the flip side, to deal size being compressed. Again, we talked earlier in the slide that the average or the median deal size for a US IPO right now is about 7 million. And that's the median, half or above, half or below. But the reality is it is a compressed and challenged market. And that brings us to this slide. I've talked more over the last 12 to 18 months about this slide and the information on this slide than any other information, because it is almost impossible right now to get a deal done in the US without selling or legacy shareholders. It is such an important concept. And I see very few people talking about it until it's too late. There is very little chance, unless you are running a very popular, wildly successful company, that you are going to be able to place a $15 to $20 million microcap IPO these days. Unless, of course, Kingswood is your banker, then no worries, you're all set. But if you do go into this world of IPOs, you should plan for raising $6, $7, $8 million. And where does the rest of that qualification come from? Because remember, setting the stage for a second, you have to qualify at 15 million public float in order to get approved for listing in the US, whether that's on the NASDAQ or the New York Stock Exchange. How we get there is another story and probably not a topic for this conversation, but $15 million is super important. And if you look here again, this slide, look at 2021 versus 2024, where we talk about IPOs greater than $15 million. It is over 90% different, given where it was in the post-COVID year. And if you look on the far right, you look at the slide in the increased participation of selling shareholders. So as deal sizes come down, $6, $7, $8 million, something has to make up for that difference. And that is really been the strategy of using either selling shareholders in the prospectus or legacy shareholders that can qualify as free trading according to the exchanges. Put those two numbers together and make up the $15 million. Now, one thing before I open up to the panel, I want to point out an inverse relationship that happened over the last 4 years, and it happens all the time. Back in 2021, investment bankers, all of them, didn't want to talk about selling shareholders. They didn't care about the legacy shareholders because they could raise close to $15 million. They were super, not important. They were very much less important. And everybody wanted to clear the decks and clear the runways for the IPO. The IPO investors are the only ones that could trade, the only ones that could be in the market because deals were of a certain size. Fast forward to 2024, the same investment bankers, same lawyers, same deal guys, consultants are begging for legacy shareholders, begging for selling shareholders. I mean, literally going to Aunt Sally and saying, give away stock to 4 of your children. We need more legacy shareholders. That's where this market has come to, because getting to that $15 million has been so hard on a primary IPO deal. So let's talk about selling stockholders and maybe some of your experience. And maybe we'll start with Mert here. I don't know if that's even a consideration in the insurance world or the risk mitigation world, but I will tell you, as far as litigation goes, sometimes it is the selling stockholders starting a litigation or causing a problem post-IPO, depending on how the stock trades, depending on how they're treated, depending if they're locked up, leaked out, and how that all sort of plays out in the deal. Is that a consideration, or is that something that we really don't have to worry about in the risk mitigation and insurance world? Because in the deal world, we think about it all the time.
It's something that we've seen claims. Yeah, we've seen directors and officers claims in that world and in the back of the underwriters' minds, but it's not the focus. They're more focused on if it's a U.S. listing and the size of the raise are the main considerations on the board.
Sure. And Jeff, when we talk, we're going to talk about cross listings and up listings in a second, but a lot of the selling stockholders in these deals are obviously legacy, and on an uplist or cross list, they're already trading. They're trading in Canada. That's what you do every day. You monitor these markets. What's your view of the selling stockholders or legacy shareholders in a deal? When a deal is actively trading in Canada and you're trying to list in the U.S., what's the feeling coming out of those selling stockholders? Is more liquidity good? Is price depreciation? How does that affect what you do? Because remember, there's always a restructuring, a consolidation, a reverse split. Talk to us about the trading aspect of a deal.
So more liquidity is good. Those shareholders are not as active as the new investor shareholder. And there's not really a lot of support, or there doesn't feel like there's a lot of support. That's the past 2-3 years.
Sure. It's been all depressed.
Yeah.
Let's talk for 1 second about lockups and leakouts as they relate to shareholders and selling stockholders, because this is a really important point. When you go to list in the U.S., we talked about getting to this $15 million number. The exchanges, at least NASDAQ and the New York Stock Exchange, treat these slightly differently. So again, getting to the $15 million is the challenge. Most of the primary IPO money coming in from the investment bankers don't love the idea of selling shareholders being registered or even having free trading paper, because generally the legacy shareholders have a lower cost basis. So, if the deal does trade down, maybe the legacy shareholders, can easily get out of their position, finally get some liquidity. Maybe they have deal fatigue. They just want to sort of be done. So there's this very much this interplay between new money and old money. But the way the New York Stock Exchange and NASDAQ treat these, for the most part, and this is just an important point for all of the CEOs and companies looking to go public in the U.S., NASDAQ doesn't generally allow shareholders who are legacy to count towards that $15 million float unless they're not locked up, unless they're free trading on day one. Whereas the New York Stock Exchange will give a little bit more consideration to locked up, leaked out selling or legacy shareholders to get to that $15 million number. It's just something that comes up often and that we should all be cognizant of. Let's go quickly. I want to mention 2 things. We're going to come back to this because I think we really got to spend some time on the uplist, crosslist market. But there's been some pretty exciting, depending on what side of the fence you sit on, industry news. I think a lot of you are familiar with the Cboe exchange that sort of came out really red hot last year and was going to be the 3rd competitor to NASDAQ and New York Stock Exchange. They had signed up, 25, 30 companies in their pipeline, going to really be the competitor and the new bright, shiny object to the market and really show NASDAQ how a listing is supposed to be done. Well, unfortunately, it seems that, Cboe, as quickly as they got into the market and listed all of 2 companies, they quickly exited the microcap market. So I know this has sort of been quietly being rolled out by the exchange and quietly talked about by professionals like us, but it appears that Cboe is no longer in the microcap senior exchange U.S. market. So that's unfortunate. We'll get back to this too with the New York Stock Exchange. They just came out with a new rule which makes legacy shareholders even more important. But in order to list on the New York Stock Exchange now, in a microcap sense, you have to do a primary deal that's $10 million or greater. That is a huge, huge impact on the microcap market. So all those median deals we just talked about, $7-8 million, can't be done on New York Stock Exchange, only on NASDAQ. But let's go to this, the state of the uplist and crosslist market. This is super interesting because this is where the Canadian market really, really intersects with the U.S. market. If you look here, on my slide, which you can see, the main jurisdictions for this uplist crosslist market, obviously Canada. Canada is a main source of these transactions to the tune of about 35% of the U.S. crosslist uplist market is Canadian companies. So lots of you in this room. Bermuda, Israel, some other countries obviously play a role in that cross-listing market too. Australia has had some prominence recently. But if you look at the data, again, 2021, 66 uplist cross-list deals. 2022, the latter part of 21 and 22, it went down to 49. And now, over the last 2 years, that orange slide, that orange number, is for almost the past 2 years. The fourth quarter of 2022 through right now, basically almost the fourth quarter of 2024, there's only been 34 deals. And here's the reason why. So when you go to do a cross list in the United States now, on the NASDAQ or on the New York Stock Exchange, NASDAQ in maybe 2 years ago stopped allowing simultaneous consolidations or reverse splits and same-day pricing or trading. On a case-by-case basis, they may allow it. But what that did is really single-handedly crushed the uplist and crosslist market because the banking teams, the CEOs, management teams, really think about that risk between a consolidation or reverse split on the day of pricing and how that will trade for 5, 6, 10 days post the consolidation. So NASDAQ said if you're doing a reverse split above a certain level, you have to do a 5-day hold trading period on your current platform, whether that's the OTC or CSE or TSX or whatever. You have to stay trading for 5 or 10 days. And that has caused a risk factor that most bankers, most companies, most management teams do not want to price into and raise money and be stuck in this limbo period of doing the consolidation and then not being able to list because there's a 10-day period. So that is what has contributed pretty much single-handedly to the, I don't want to say the demise, but the severe challenging nature of this uplist market. So again, maybe Peter, you could tell us your experience because this really is your world. I mean, if there was a slide up here for you, this is it.
Yeah, so we've definitely seen the effect of that. We've seen a lot less people wanting to cross-list. And it's because, like you said, there's no real price protection you can do because you got to wait for it to trade. And then if you don't get there, the deal's going to blow up. So bankers don't want to do it. So we're just seeing people not want to do that a lot more. And frankly, it's led to, I think, more direct listings because organic listings, right? Like people are choosing to directly list versus, in the past we used to do a lot of, we'd list on the TSX or the V and then we'll uplist later. And clients are doing a lot less of that. They just want to directly list in the US. And that's got a lot to do with it, I think.
Yeah, one thing Peter mentioned, which I didn't, which is a great point, is that the organic listings, we didn't talk about those, but remember, an uplist we generally refer to as a company or a cross list that's raising money to go on a U.S. exchange. But a lot of times in Canada and in the U.S., we do what's called an organic listing, not so much direct. I think you call it direct, but really organic. And that means that the companies are really just doing their consolidation without raising capital or somehow otherwise getting the pricing mechanics of the trading market worked out and listing without a capital raise. And we've seen those transactions grow a little bit in the marketplace as well. Mark, quick question. Is there a difference between an IPO, which is private to public, or an already trading uplist, cross-list, Canadian or otherwise, as far as risk mitigation and insurance? Are the premiums priced differently? Does it matter? Do they look at trading history? What is sort of the state of that world? Because again, D&O has become such an important part of our process. Everybody's talking about it. Everybody wants it. Everybody needs it, except the people that have to pay for it, by the way. What are you seeing on that front?
That's a really good question. I mean, from what we're seeing, it's not really that big a difference if we deal with Canadian companies, so whether you're doing an organic listing or an uplisting or a cross listing, the pricing will be roughly the same. The big issue is there a raise, and how much is the raise? That is gonna, in the States, that's gonna attract more premium and more risk. But all things being equal, whether it's an organic listing or an uplisting, it depends on the size of the raise.
Right. And Jeff, this is really your slide as well, because the uplisting, cross-listing market is what you see the most as far as trading in Canada and then listing in the US. What are you seeing in the marketplace, and how are shareholders reacting, market makers reacting? Anything different that you're seeing now? I know liquidity has been down, but this is really your space.
Yeah, if it's trading okay or well in Canada and struggling in the U.S., there's the market makers in the U.S. keep the spread. They don't. It's not set up like a really actively traded stock that trades interlisted, and with the foreign exchange difference, there's really not a lot of give. With the smaller cap, smaller volume stocks, the market makers in the States tend to keep their spread a little bit wider, just outside the Canadian quote, which really keeps the volume or what little volume there is in Canada, unless there is somebody that can go in and tighten that spread.
Sure.
If that makes
Thank
sense.
you for that. One last question, Mert. If the company in Canada has lots of liquidity, let's pretend for a second, okay? Lots and lots and lots of liquidity. Does that liquidity get worse pricing or better pricing than the company that doesn't trade?
I think it's better. It's a favorable factor in the minds of the underwriters.
Okay. Yeah. I think we only got a few minutes left. I was told we could open the floor to some questions if there are any. So if anybody wants to ask a question, I think we have a couple seconds left. Right here.
What are your thoughts on algorithmic high-frequency trading in relation to market?
Jeff, I think that's tailor-made for you, man.
Algorithmic activity, there's good algo activity, there's not so good, there's predatory activity. High-frequency trading is fast algorithmic activity. In what we're discussing mostly with the small cap volume or stocks that are struggling with their volume, I don't think it's as damaging.
I'll tell you this. I can answer that from a regulatory perspective because we see this. So on the legal end, we do a deal, and then what happens is NASDAQ, FINRA, all the regulatory exchanges end up looking at the trading history, especially out of the gate. And there is probably some algorithmic trading that contributes to the problems. There's also just other problems in the US, which I think the regulators have been working for now a few years to fix ever since the boom of 2021. But I will tell you, we are seeing a lot more inquiries from NASDAQ, from FINRA, from the SEC, from other regulatory agencies that have three letters about trading. And it is a lot more active. And I don't know if it's good or bad. I don't know who's doing what to whom. But I do know it is a huge issue in the US. So much so where in March of this year, NASDAQ implemented these new rules where now banks have to become a member of NASDAQ, get approved to do an initial public offering or initial listing on NASDAQ before anybody that had a FINRA license and was qualified could do a deal. So it's caused the U.S. market, at least from the 43 microcap investment banks that we track, to go from 43 to maybe 30 of them are approved thus far, mainly because of trading and the ups and downs of the trading market, especially on day one. And they have gotten, an organization called FINRA down in the U.S. more involved in reviewing those trades. So it's a great question. We see it from the regulatory side and, Jeff from the market making side. I think, any last question? Otherwise, I think we got to wrap it up because I'm getting smiled at very nicely. All right, well, thank you, everybody. Really enjoyed being here.